Most traders chase profits while missing the real transformation happening within themselves. The market reveals its truth not through winning trades, but through the subtle shifts in your psychology and methodology. After observing thousands of price movements, I've identified 5 unmistakable signs that separate the struggling amateur from the consistently profitable professional. These markers don't appear overnight. They emerge when you finally stopped fighting the market and started reading it. You'll know you've turned the corner when a losing trade no longer disturbs your evening. When you stop predicting and start responding, when volume speaks louder than price. The composite operator doesn't announce his intentions, but he leaves footprints. Your ability to follow these footprints, rather than your own hopes, marks your evolution from gambler to tactician. My years of studying the market have taught me one fundamental truth: the tape tells everything. But most traders never learn to read it properly, because they're too busy reading their own hopes and fears instead. When I first began my career on Wall Street, I watched countless speculators approach the market with their minds already made up. They wanted the market to go up, or they desperately needed it to go down. Their positions dictated their interpretation of price action. This is the fatal flaw that keeps the majority of traders locked in mediocrity. The tape that continuous record of price and volume speaks in a language all its own. It reveals the intentions of the composite operator, that powerful force representing large institutional interests working to accumulate or distribute stock. But you cannot hear what the tape is saying if your emotions are shouting louder. Consider what happens during a typical trading day. Prices fluctuate, volume ebbs and flows, and somewhere in this seemingly chaotic dance lies the truth about supply and demand. When you see price advancing on increasing volume, the tape is telling you something specific about demand. When price struggles to move higher despite heavy volume, effort is producing minimal result, a warning sign of potential weakness or supply overwhelming demand. The profitable trader I've become didn't emerge until I learned to silence my personal desires completely. I trained myself to observe the relationship between price movement and the volume, accompanying it with the detachment of a scientist studying specimens under a microscope. What is the composite operator doing? Are they accumulating during this trading range, shaking out weak holders before a markup phase? Or are they distributing, unloading shares to an eager public near market tops? You know you've achieved this critical transformation when you can watch your own position moving against you and still analyze the price action objectively. Instead of panic or frustration, you note the character of the decline. Is volume expanding on the down move, suggesting genuine selling pressure, or is it diminishing, indicating merely a natural reaction within an uptrend? This discipline extends beyond individual trades. The successful speculator maintains detailed records not just of profits and losses, but of market conditions, volume patterns, and the relationship between effort and result across different phases. I filled countless journals with observations about how price behaves at support and resistance levels, how volume confirms or denies apparent breakouts, how the composite operator reveals himself through subtle inconsistencies in price action. The emotions haven't disappeared entirely, I'm human after all, but they no longer control my interpretation of market data. The tape speaks, I listen. It shows me accumulation, I prepare for markup. It reveals distribution, I anticipate decline. This is the difference between speculation and gambling, between the professional and the amateur. When you reach this point, trading transforms from an emotional roller coaster into a systematic study of recurring patterns and principles. Throughout my years of market study, I've observed that the stock market operates according to natural laws as reliable as those governing physics. Chief among these is the law of cause-effect. And understanding this principle marks the dividing line between the novice and the professional trader. Let me explain this law plainly. Before any significant market movement occurs, there must be adequate preparation. The cause is the trading range, the period, accumulation or distribution. The effect is the subsequent markup or markdown that follows. The magnitude of the cause determines the extent of the effect. This isn't speculation or theory. It's observable fact, confirmed by studying thousands of market movements. When I first grasped this principle, it revolutionized my approach to trading entirely. I stopped chasing stocks that had already made substantial moves, hoping to catch the tail end of a trend. Instead, I learned to position myself during those periods when the composite operator was quietly accumulating shares from discouraged sellers or distributing shares to optimistic buyers. Consider a stock that has been trading in a horizontal range between $40 and $45 for several months. The uninformed public grows bored, dismissing it as dead money. But what does the student of tape reading see? He observes the volume, the character of the rallies and reactions within that range, the absorption of selling pressure. He's watching the composite operator build a position, creating the cause. The width and duration of this trading range, this cause allows me to project the potential extent of the subsequent move. A narrow range of a few weeks might produce a moderate advance, but a wide trading range sustained over months, this builds cause sufficient for a substantial markup campaign. The professional trader cultivates patience during the preparation periods because he understands that rushing the market is futile. I've seen countless traders destroy themselves by ignoring this law. They buy stocks making new highs without any consolidation, without adequate cause being built. They're buying the effect after it's already largely spent, entering precisely when the composite operator may be distributing to them. Or they grow impatient during accumulation phases, selling out just before the markup begins because nothing is happening. The transformation occurs when you internalize that nothing significant happens instantly in the market. Even what appears to be a sudden breakout has been prepared through careful accumulation. The composite operator doesn't work in days, he works in weeks and months, building positions that won't be liquidated until substantial profits can be realized. I trained myself to measure these causes systematically. I chart the trading ranges, note the volume characteristics, observe how supply is absorbed or demand satisfied. This measurement isn't guesswork, it's a practical application of a fundamental market law. When you've truly embraced this principle, your entire trading psychology shifts. Patience ceases to be a virtue you struggle to maintain and becomes a natural response. You understand that waiting for proper cause to develop isn't missing opportunities. It's the very foundation of creating them. The market rewards those who respect its natural rhythms and punishes those who fight against them. This respect for cause and effect has made me more profits than any other single principle I've learned. In all my years of trading and teaching others the methods of successful speculation, I've witnessed one truth repeatedly: more fortunes are lost through improper position sizing than through faulty market analysis. A trader may read the tape perfectly, identify accumulation accurately, and still find himself ruined because he committed too much capital to a single campaign. The amateur approaches the market with the gambler's mentality. He sees what appears to be a certain opportunity and commits his entire capital or worse. Leverages beyond his means, believing this trade will be the one that makes his fortune. This is not speculation. This is reckless gambling, and the market has no mercy for such foolishness. When I developed my trading method, position sizing became as important as any technical analysis. Each commitment of capital must be proportional to both the strength of the opportunity and the distance to my predetermined stop-loss point. This isn't a suggestion, it's an ironclad rule that has preserved my capital through countless market campaigns. Let me illustrate with a practical example. Suppose I've identified a stock completing accumulation, showing all the proper characteristics: absorption of supply, testing of support, and spring action that shakes out remaining weak holders. My analysis suggests an entry at $50 with a logical stop loss at $48 based on the structure of the trading range. This represents a $2 risk per share. Now here's where the professional distinguishes himself. Rather than buying as many shares as my capital allows, I calculate backward from acceptable risk. If I'm willing to risk $2,000 on this campaign, I can purchase 1,000 shares. No more. This discipline ensures that even if my analysis proves incorrect, and it sometimes will, I live to trade another day. The composite operator himself operates on this principle. He doesn't commit his entire resources to a single accumulation. He diversifies his campaigns, manages his exposure, and always maintains reserves for unforeseen opportunities or to weather temporary adverse movements. Should I do any less? I've counseled many traders who came to me after devastating losses. Without exception, their downfall traced back to position sizing errors. They might have been right about market direction, but they sized their positions so aggressively that normal market fluctuations triggered their stops, or worse, margin calls. They transformed what should have been manageable losses into catastrophic ones. The transformation I've observed in successful traders invariably includes the shift in position sizing philosophy. They stop asking, how much can I make on this trade? And start asking, how much can I afford to lose? This isn't pessimism, it's professionalism. I maintain detailed records of every position, entry price, stop-loss level, share quantity, and the percentage of total capital at risk. Before entering any trade, I know exactly what I'm risking and have accepted that potential loss as the cost of the opportunity. This preparation eliminates the emotional turmoil that destroys so many speculators. Capital preservation isn't a defensive strategy, it's the foundation of offensive success. You cannot compound profits without capital to compound. A professional trader who consistently applies sound position sizing principles will, over time, outperform the brilliant analyst who risks recklessly. The market rewards discipline far more generously than it rewards cleverness. This lesson, though simple, took me years to fully embrace. Now it's second nature. The greatest psychological barrier every trader must overcome is the emotional devastation that accompanies losses. I've observed that until a speculator can accept losses as an inherent, unavoidable cost of doing business in the market, he remains a prisoner of his own emotions, and the market exploits emotional prisoners mercilessly. Early in my career, I experienced the same anguish that plagues every novice. A stopped-out position felt like personal failure, a judgment on my intelligence and ability. I would replay the trade endlessly in my mind, torturing myself with what I should have seen, what I should have done differently. This psychological turmoil was far more costly than the financial loss itself, because it clouded my judgment on subsequent trades. The turning point came when I began studying the operations of the composite operator with greater depth. I realized that even the most sophisticated market operators, those moving millions of dollars with careful planning, experience losses. They probe for supply and demand, test support levels, and sometimes their tests fail. The difference is that they treat these failures as information, not as catastrophes. Consider the nature of speculation itself. We are attempting to profit from future price movements in an environment of genuine uncertainty. No amount of analysis, no matter how thorough, can eliminate this uncertainty completely. The tape reveals probabilities, not certainties. When I enter a position based on sound accumulation evidence, I'm acting on high probability, but probability is not guarantee. Once I internalize this truth, my relationship with loss is transformed entirely. A stop being hit now tells me something valuable, my analysis was incomplete, or market conditions changed, or the composite operator's plans shifted. The loss is tuition paid for education in market behavior. Would I refuse to pay tuition to attend the finest university? Then why would I resent paying the market for its lessons? I developed a systematic approach to losses that removed the emotional sting. Before entering any trade, I predetermined my stop-loss point based on the logical structure of the campaign. This stop represents where my analysis is proven wrong. When price reaches that level, I exit without hesitation, without hope, without the dangerous thought that it might come back. The market has spoken, I listen. More importantly, I refuse to carry the psychological weight of that loss into my next decision. Each trade stands alone as an independent event. The fact that my previous trade lost money has absolutely no bearing on whether my current opportunity is sound. This mental separation is crucial. I've watched countless traders enter a self-destructive spiral after losses. They either become paralyzed by fear, unable to take valid signals, or they begin revenge trading, doubling their positions to recoup losses quickly. Both responses are emotional, and emotional decisions in the market are almost invariably expensive ones. The professional trader I've become maintains perfect emotional equilibrium. A winning trade doesn't make me brilliant, a losing trade doesn't make me foolish. Both are simply outcomes in a probabilistic endeavor. I judge myself not on individual results, but on whether I followed my method with discipline. This psychological mastery didn't arrive through willpower alone. It emerged from understanding that losses are not obstacles to success, they are components of it. Every successful campaign I've conducted has been financed in part by accepting small losses when the market proved my analysis incorrect. When you reach this state of acceptance, trading becomes remarkably peaceful and paradoxically far more profitable. One of the most dangerous delusions a trader can harbor is the belief that he can predict the market with certainty. I've spent decades studying price movements, accumulation patterns, and the operations of the composite operator, yet I would never claim to know with absolute certainty what the market will do next. This distinction between probabilistic thinking and the illusion of certainty separates the consistently profitable trader from those who experience occasional lucky successes followed by devastating failures. When I first began teaching my methods, students would often ask me to guarantee that a particular setup would work. They wanted certainty. They wanted me to promise that if they identified accumulation correctly and entered at the proper point, profits were assured. I had to disappoint them with the truth. There are no guarantees in speculation, only probabilities weighted in your favor. The market is influenced by countless variables, some visible, many hidden. The composite operator's plans, while methodical, can change based on conditions I cannot observe from my position. Economic news breaks unexpectedly. Public sentiment shifts. War, legislation, technological disruption, all these factors and more create an environment of irreducible uncertainty. What I can do, and what I've trained myself to do with considerable skill, is identify conditions where probability favors a particular outcome. When I observe a stock completing a thorough accumulation phase, showing absorption of supply, successful tests of support, and a spring that shakes out remaining weak holders, I'm not guaranteeing it will advance. I'm recognizing that historical patterns suggest a high probability of markup following such preparation. This probabilistic framework completely changed how I approach trading. Instead of needing to be right on every trade, an impossible standard that generates tremendous psychological pressure, I simply need to be right more often than I'm wrong, and to manage my position so that my winners exceed my losers in magnitude. Consider a professional poker player. He doesn't need to win every hand. He needs to play hands where probability favors him and fold when it doesn't. Over hundreds of hands, this probabilistic edge compounds into consistent profits. The stock market operates on identical principles. I've developed the discipline to take every valid setup my method identifies, knowing that some will fail. Perhaps 3 out of 10 setups produce substantial profits, 4 break even or generate small losses, and 3 stop out. But those 3 winners, properly managed with trailing stops during the markup phase, can generate profits that dwarf the combined losses from the 7 less successful trades. This is the mathematical reality of speculation that eludes most traders. They take 1 or 2 trades, experience losses, and conclude the method doesn't work. They fail to understand that no method works on every single trade. Methods work over series of trades where probability expresses itself through repetition. The transformation I underwent wasn't learning to predict better, it was abandoning the need to predict at all. Instead, I learned to recognize favorable probability, position myself accordingly, and let the law of averages work in my favor over time. I now approach each setup with calm detachment, Will this particular trade work? I don't know, and I've stopped pretending I do. What I know is that this type of setup, when repeated consistently over many instances, produces net profits. That knowledge is sufficient. When you finally embrace probabilistic thinking, the psychological burden of trading evaporates. You're no longer trying to be omniscient, you're simply playing a favorable game repeatedly and letting mathematics do its work. Of all the analytical tools I've developed and refined throughout my career, the principle of effort versus result stands as perhaps the most revealing indicator of future price movement. This concept, though simple in statement, requires years of careful observation to master, yet once mastered, it unveils the composite operator's intentions with remarkable clarity. Let me define these terms precisely. Effort is represented by volume, the amount of trading activity occurring at any given price level. Result is the corresponding price movement that effort produces. The relationship between these two elements tells us everything we need to know about the balance of supply and demand at critical moments. When I observe large volume producing minimal price change, I'm witnessing a profound market event. Significant effort is being expended, yet it's failing to generate proportional results. What does this tell me? Either supply's overwhelming demand on an upward attempt, or demand is absorbing supply on a downward move. This disharmony between effort and result signals potential reversal points with remarkable consistency. Consider a stock that has been advancing steadily. It approaches a previous high, and volume expands dramatically, perhaps twice the average daily volume. Yet despite this enormous effort, price barely penetrates the old high and closes near its low for the day. The effort was substantial, but the result was negligible. This is the composite operator encountering supply, testing whether he can distribute at these levels. The market has shown its hand to those trained to observe. Conversely, when I see price advancing easily on diminished volume, significant result, with minimal effort, I understand that supply has been exhausted. The path of least resistance is upward because sellers have been absorbed during prior accumulation. This harmony between effort and result confirms the trend's strength and the composite operator's control. I've trained myself to scrutinize these relationships every critical juncture, breakouts from trading ranges, tests of support and resistance, climactic movements and reactions within trends. Each instance provides intelligence about whether the current movement is genuine or false, whether accumulation or distribution is occurring, whether strength or weakness lies beneath the surface. The uninformed trader sees only price. He observes a stock making new highs and assumes strength, or breaking support and assumes weakness. But price alone deceives. It's the relationship between the effort required to produce that price movement and the result achieved that reveals truth. I recall countless instances where stocks appeared strong based on price action alone, yet the effort versus result analysis revealed underlying weakness. Heavy volume on minor price gains indicated the composite operator was distributing into strength, unloading shares to an enthusiastic public. Those who bought based on price momentum alone became the victims, while those who analyzed effort versus result avoided the trap or even profited from the subsequent decline. This analytical framework requires patience and disciplined observation. I maintain charts that show not just price, but volume bars scaled to reveal the relationship clearly. I study these patterns repeatedly until recognizing harmony and disharmony becomes instinctive. The beauty of this principle is its universal application. It works in bull markets and bear markets, in individual stocks and market indices, during accumulation and distribution phases. Why? Because it reflects the fundamental reality of supply and demand, which governs all market movements regardless of external conditions. When you've developed the ability to consistently analyze effort versus result, you possess a lens through which market manipulation and composite operator intentions become transparent. You're no longer trading blind. You're reading the market's internal dynamics with the skill of a master diagnostician reading symptoms. This understanding transformed my trading from guesswork into systematic analysis, and it remains the cornerstone of my method to this day. My friends, I've laid before you the 6 unmistakable signs that mark your evolution from amateur speculator to professional trader. These aren't merely techniques to be memorized. They represent a fundamental transformation in how you perceive the market and yourself within it. Reading the tape objectively instead of through the distorting lens of emotion. Respecting the law of cause and effect by waiting for proper preparation before campaigns begin. Sizing positions as a professional manages risk, not as a gambler chases fortune. Accepting losses as business expenses rather than personal failures. Thinking in probabilities across many trades instead of demanding certainty on each one. Analyzing effort versus result to see through the composite operator's intention. These principles didn't reveal themselves to me in a moment of inspiration. They emerged through years of careful study, painful losses, hard-won victories, and relentless observation of market behavior. I've paid my tuition to the market many times over, and these 6 signs represent the education I purchased with that tuition. But here's what I want you to understand. These signs don't appear because you've read about them, or because you intellectually agree with them. They manifest when you've internalized them so deeply that they've become your natural response to market conditions. You'll know you've arrived when you find yourself analyzing effort versus result without conscious thought, when proper position sizing feels instinctive rather than restrictive, when losses truly no longer disturb your equilibrium. The path from where you are now to consistent profitability isn't mysterious or hidden. It's systematic and observable. Traveled by every successful speculator who came before you. The market itself will teach you these lessons painfully if you resist, or efficiently if you approach it with humility and discipline. I cannot promise you that following these principles guarantees wealth. The market makes no promises to anyone. What I can tell you with absolute certainty, earned through decades of direct experience, is that ignoring these principles virtually guarantees failure. The market has no mercy for those who approach it with hope instead of method, with emotion instead of analysis, with greed instead of discipline. Study the tape, respect natural laws, manage your capital as if your survival depends on it, because it does. Accept uncertainty, think probabilistically. Analyze effort versus result. Do these things consistently, patiently, systematically, and you'll discover that profitability isn't a destination you reach, but a natural consequence of professional behavior repeated over time. The market stands ready to teach you, as it taught me. The question isn't whether these lessons are available. They're being offered every single day the market is open. The question is whether you're willing to be the student the market requires, disciplined, patient, objective, and humble. Your journey to profitability begins not with finding the perfect setup or the secret indicator, but with becoming the type of trader who can recognize opportunity, manage risk, and execute with emotional detachment. These 6 signs will mark your progress along that journey.